Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 29th of May, and we've got Brent crude oil trading above $84 a barrel, 84.39, sort of broken that grip of the lower 80s, making a run for the exits to get to 85. Michelle Maidan, head of China Research Program at the Oxford Institute for Energy Studies. Michelle, we had some fairly positive noises out of the IMF overnight, raising growth forecasts for China. Have we been underestimating China's economic performance this year, and with it being a bit bearish on where its pull on oil prices can be? Your thoughts on the IMF announcement?
Good morning, Sean. Look, I think we tend to see this slew of bearish sentiment in Q1, and Q1 data from China is always patchy. And then people tend to sort of coalesce in terms of their GDP forecasts starting in Q2, especially if Q1 wasn't dreadful. We've been hearing a lot of noises out of China about stabilizing the real estate sector. But, the IMF is fundamentally aligning with the Chinese government sort of around 5% GDP forecast for the year. It is becoming harder to read because the traditional drivers of growth, like the real estate sector, are no longer what is really driving both economic activity and sentiment in China. And so it's really, I think, a bit of a kind of matching game. The reality is that the recovery remains relatively weak and very, very complex. The government's looking to stabilize the real estate sector, but that's very difficult. There's a problem with employment, there's a problem with consumption. Now, what's called the new productive forces, right? This big industrial push to do electric vehicles, batteries, solar panels, that is all still maintaining growth and helping it, but it's probably not enough to keep a very sort of bullish outlook for the Chinese economy.
Let's welcome Daniel Richards, Middle East North Africa economist at Emirates NBD here in Dubai. Daniel, one of the things that has sort of been guiding our sense of the oil markets really for some time now, post-COVID, has been Saudi Arabia's North Star of this massive economic reform program. The signature headline being NEOM and what they call these giga projects, literally hundreds of billions of dollars of expenditure needed for that. And hence the sort of robust attitude towards an elevated oil price, the desire for one. Your thoughts on where Saudi is on that, given now they've backed away, they've announced some of the, delaying those big projects, pulling back from some of those big dates, target dates. Your thoughts on where Saudi fiscal needs intersect with oil price?
Yeah, so as you say, there has been some rollback or some acknowledgement, at least, that some of those big projects, especially the kind of more headline generating ones like the line, which has been the scope of which has been fairly dramatically pared back. But even if you take that into account, there's still massive spending requirements in Saudi Arabia. And I think some of these projects are always very ambitious, but even taking those out of the equation, there's still going to be huge spending going on in Saudi Arabia. Aside from the kind of headline generating thing, there's still infrastructure investment needed in roads, in schools, in hospitals, into everything really. And when you take into account that some of that is timely, especially around the infrastructure that is going to be needed for the sporting events, the upcoming sporting events, the Asia Olympic Games, FIFA World Cup, the Expo, some of this will still need to go forward regardless. So even if some of those big projects won't materialize to the same degree, there's still going to be a huge amount of spending. And even when you look at the budgeted spend in Saudi Arabia, we see a deficit equivalent to 4.2% of GDP this year. It was around 2.1% last year. So still significant funding requirements needed. And I think that's kind of what's leading, well, the big issuance in January of $12 billion. And then there were some reports over the last several days or over the last day or so around this potential Aramco sale as well. So there is a paring back of some of those projects, but there's still a lot that's going to be spent, and they still need a lot of money to do so.
Let's welcome Ilya Buchichev, managing partner of Pentalon Investments and author of the book Virtual Barrels. Where are the virtual barrels at the moment, Ilya Buchichev? I'm kind of looking at this space between the Fed rate cuts or the absence thereof and inflation, which of course has sort of been one of the main North Stars for financial markets for many, many months. Will they cut? Won't they cut? Later cut, up, down on the NASDAQ, but ultimately all moving in an upward direction. Your thoughts on where we are now as OPEC's about to sit down? How should they read the tea leaves on the intersection between rate cycle and oil markets for particularly the Fed?
Good morning, Sean. I would kind of separate these two questions into two. One is OPEC and one is Fed. On the OPEC side, I'm not going to be overly controversial. I think it's very difficult to say that something is not going to happen. But in this case, the consensus prevails that they're going to extend the cuts. And I basically agree with that. I think they're doing a marvelous job essentially helping the price to stay where it is. And what I would say, defending the attack of short speculators who have been selling the market quite aggressively, actually, but the price surprisingly held up. So in my opinion, OPEC wants to exit the cuts into the price strength. So, and that strength has not arrived yet, for a number of reasons. So one is a fundamental, because we were coming out of a fairly weak seasonal demand into the strong demand. So, and in the second part of the year, those virtual barrels, the financial speculators, are much more likely to cut their very significant short positions. And that's what OPEC wants. So OPEC wants to sell into the strengths, to show that they are in control of the market. That strength has not arrived yet, but it's much likely, much higher probability that it will arrive sometime in the next Q3. So my view is no cuts, sell into the strengths, be a little bit more patient. Yeah.
Sorry, Ilya?
Yeah, and that's on the OPEC side. And on the financial side, on the Fed side, I think that question is a little bit trickier, because people tend to oversimplify the relationship between oil inflation and US dollar. It's quite complicated. So as humans, we always like to think about causality. If something happens, then something happens.
Well, we've seen causality in the sense that when the outlook, the sentiment appears to be that rate cuts are more imminent, that tends to the financial markets, including oil, take that as a bullish sentiment, because there'll be more money in everybody's pocket to consume. And when rate cuts seem further away, it has the opposite effect. Generally speaking, where do you think the Fed are, regardless of your thoughts on causality, but in terms of Fed cuts or not this year, your thoughts on whether they will come in the second half?
Again, the consensus is they'll cut by the end of the year. But to me, I think what's more important, I think I would challenge on this one. I would actually challenge the consensus, because, as you said, the traditional way of thinking. So we tend to think, oh, if interest rates are high, that's generally bearish oil, and the traditional thinking is because it's going to hurt demand, or high interest rate also increases the cost of holding inventory. However, if interest rates are high, that also means we are in an inflationary period. And if we are in an inflationary period, there is a lot of financial speculators simply holding oil, not the hedge funds, but the financial investors holding oil as a structural inflation hedge. Now, what's going to happen if they do cut? Well, both channels are basically going to revert. So if the interest rates are going to drop, let's say if they cut, then so what's going to happen? Well, I'm not actually sure it's going to impact the demand much, but if they're going to cut, then more likely the US dollar is going to drop. So if US dollar is going to drop, that's bullish oil, because oil is priced in dollars.
Yeah,
however,
there's a lot of ifs there stacked up on top of each other. Michelle, let's go to something a little bit more definitive. Despite the IMF's correction of expectation upwards of Chinese growth, up 0.4% for 2024 and 2025, so up from 4.6% up to 5%. But they still signaled that China could do more. The old school scorecard, could do better in the property issue, in addressing China's property sector issues, more comprehensive policy packages. And you mentioned it in your earlier comment that it remains. But my question to you is, this is not a new headline. This has been with us probably a year now, since Evergrande first had its big drama of whether we were on the doorstep of a US scale, property crisis like we saw in 2008-09. So the Chinese government's had a good year at trying to chip away at this problem. My question is, are they making any impact? Is it getting any better? Is it getting any worse? Where we are in the progression? Because it's a year now since this red light started flashing.
Well, and it's been much longer, right? Since the real estate sector has been a concern for the Chinese economy. It's a very fine balance, right? Between trying to stabilize the sector, but not reinflating a bubble. And I think we all overly focus on the real estate sector. I'm not convinced that that is what keeps the Chinese government up at night. Yes, it is one of the elements that they have to deal with, because a lot of people's wealth and the economy is tied into the real estate sector. But if you look at their priorities, and of course we'll see more about that in the July plenum, the big Communist Party gathering that's going to happen, they are equally and even more worried about local government debt, which is what is actually the fuel of the economy, of employment, of job creation, of the social security that they need to set up in order to put China on a more sort of sustainable footing longer term. They're equally concerned about the securitization of the economy with, a very negative external environment from a geopolitical perspective, not necessarily also from an economic perspective, but they see a lot of threats coming in. And so what we or the IMF would look at is say, this is where you should be heading because you want to reach certain economic outcomes, is not what the Chinese government is looking at. And so I think we need to stop focusing so sort of fixedly or solely on the real estate market. And again, I think the key word and the buzzword in China now is the new productive forces, and these are the new industries. And of course, industrial overcapacity is something that we see in the news frequently. Those are some of the drivers of industrial energy demand growth. And in terms of oil, right, it's transportation that is still a big driver of growth. Certainly jet, a little bit of gasoline, and the chemicals sector, which is leading. So the other element, and it alludes a bit to what Ilya was saying earlier, is that there is a disconnect between the macroeconomic fundamentals and where oil is going in China in terms of the demand outlook.
Daniel, just back to Saudi, trying to get a sense of how challenged their fiscal position at the moment, turning to the bond markets to plug the budget deficit. We also have reports that for the first time this year, they're going to be cutting prices into Asia for July OSPs. Your thoughts on what that adds up to from a point of view of Saudi sort of OPEC plus oil supply policy, where those two are intersecting?
Yeah, I mean, the big thing will be watch, of course, this weekend, but similarly, we don't really expect any significant change on that. Maybe there will be some easing off for a second half of the year, but I think the expectations of those cuts will be maintained because Saudi needs oil at a high level. It's not even close to its break-even level, which is probably more in the region of $100 a barrel, maybe even a bit more. We're far off that. So obviously, they will need to continue issuing debt if they want to maintain that kind of level of spending, which they are committed to. Back in October, they said they changed their outlook on the fiscal stance, on the fiscal deficit projections. They expect now that they will be in deficit for the next 3 years. As I mentioned, we expect the fiscal deficit equivalent to GDP to double this year. So they will maintain efforts, I think, to try and keep oil at a relatively healthy price, and probably preferably for them above that. And of course, that will feed through into their policy in terms of whether they start easing off on those voluntary cuts. The thing to watch for, I think, notably for the region, for the UAE in particular, will be if there be a change for the kind of benchmark production levels for the UAE, if some of that is eased off. But given that oil is still under pressure, I think the likelihood of that is perhaps less likely, and perhaps leading to some further fraught conversations between members going forward.
Just to follow up on that, Dan, you mentioned the UAE. Obviously, the Saudi fiscal deficit they're facing at the moment, at a time when they're also carrying the biggest cut within the OPEC plus countries. They're carrying the heaviest bucket in support of the oil markets. Where is the rest of the Gulf region, the other OPEC plus members here? They don't seem to be seeing similar deficits as Saudi.
No, especially for the UAE, we expect another year of a fairly sizable budget surplus, and that's even despite our expectation of a strong budget spending, public investment over the next several years. Private consumption, we think, might start coming under a bit more pressure. It hasn't really been as robust as you might have expected it to, but public investment, public spending has been very strong. We'd expect that to remain so. So for the UAE in particular, it's in a far healthier fiscal position as it stands in Saudi Arabia.
Ilya, just coming back to your earlier point there regarding, going with consensus for the OPEC plus rollover, that they will ultimately keep everything as it is. Obviously the voluntary cuts expire at the end of June, and the other cuts expire at the end of the year. If that's the consensus for the immediate, at what point do you expect them to start looking to unravel? When could they? And given this lingering backdrop, as mentioned there by Daniel, that basic quotas are going to be coming up for consideration before the end of the year, when can OPEC Plus start to sort of loosen supply tightness?
I think it has to do more with price than it has to do with the calendar. Whenever we see $90, above $90 for any kind of sustained period of time, then they're going to start unwinding almost regardless of what they agree on, because the cuts are voluntarily. So if the market runs towards 100, above 90, and it stays there for a month, then they may come up with some kind of a miracle announcement that we are here to police the market. And whenever it's going to happen, when price is going to rally. If price not going to rally, in my opinion, they're just going to sit tight. So it's really not a calendar question, it's a price question.
Well, there is a calendar question, because ultimately the voluntary cuts expire at the end of June, i.e. 2.2 million barrels a day. So if they don't do anything, then they expire. And also at the end of the year, the current quota system expires. So there is calendar dates there.
You're correct. You're correct.
Have to be addressed.
What I meant, I already assumed that they're going to roll over voluntarily cuts through at least, let's say the end of the year. And then we do have some kind of a price spike of upward of $10 between now and the end of the year, just because we are moving into seasonal demand upswing. And that's ultimately what OPEC is betting on. So we passed the difficult part. We passed the winter. Now we are going into the summer, where the demand is picking up, and that's what they're hoping for. So in the next 3 months, we're going to have $10-15 rally, and that's when they're going to announce that they're at least voluntarily cuts. We're going to start unwinding. That's sort of my base case scenario.
Let's go to this survey question and see what the view in the room is on this. Will OPEC now look to unravel cuts after IMF upgrades China's 2024-2025 GDP growth forecasts after a strong Q1? will OPEC now take that signal, as mentioned there by Ilya, that they've got through the tough part of the sort of low demand window and now looking to a tighter second half. Now we've got China upgrade in growth, up 0.4%, not insignificant. Might see another revised upward in the second half. Is this the signal for OPEC to unravel? Yes or no? The thoughts there. Michael, I wanted to get your thoughts on where China goes at the moment vis-a-vis these so-called tariff wars. I have to say, I come out of it with the sort of big headlines recently of the EVs into America being quadrupled on their customs duties, China EVs to America from 25% to 100%. Will China retaliate, etc.? Where is that at? How big of a face-off is this? And where does it start to suck in? You're either with us again or against us, i.e. in all of the other countries that are sort of caught in the middle. But just first of all, where is the US-China piece at the moment?
So symbolically, it's huge, right? Symbolically, it's a massive issuance of tariffs. I mean, in reality, it's quite small because all of the goods that are in that list are already under tariffs, and there are relatively few exports directly from China to the US. But it does set us up for the future. It sort of sends the signal that we don't want your goods and products going forward either. So symbolically, again, not great. I think the Chinese understand that this is just as much about electoral grandstanding as it is about wanting to protect the domestic market and sort of gear up for that race with China for new energy supply chains. I think the reality is that it is going to make the decarbonization and the US's energy transition that much harder. I mean, Chinese goods components are much lower cost and they are abundant. Chinese capacity now is probably enough to supply the world in sort of various goods 2 times over, again, depending on which part of the new energy supply chains you're looking at. But, China, I think, will retaliate. I think what they try to do is find a symbolic way to retaliate that doesn't hurt the Chinese economy, that sends a signal. I think they'll probably look to target maybe agricultural products or something that hits an electorally important state, again, to send a message. But what is now tit for tat and slightly contained, will just continue to escalate and becomes bigger. I think what it does then is add costs, logistical constraints, which all feeds into sort of inflationary pressure and ends up slowing down the energy transition. Third countries, however, stand to benefit from some of this because there's this move by Chinese companies as well to relocate supply chains into FTA countries or other countries where their goods can go into the US. And of course, the big concern is that the EU follows suit and imposes all these tariffs and duties on Chinese goods. So actually, some third countries benefit from this because they get more investments, more infrastructure, more outflows, and sort of new parts of their economies emerging. I think net, if we look at it from an energy and oil perspective, it does increase demand, right? There's just a lot more activity that's happening, but it is shifting in terms of geography. It is, I think, creating more jittery and nervous markets because you never know when another shoe is going to drop, and that shoe will have sort of ripple effects that were unintended, but that are much more meaningful than, what was a symbolic gesture. And I think that's really been the issue. And we've seen it, right, with Russia and Ukraine. The unintended consequences are the ones that can be the most impactful and harmful.
I wanted to get your thoughts also on the other point made in the IMF statement overnight, which was, yes, a revised upward growth for China in 24 and 25, but notably as the out years start to decline, and by the end of the decade, 2029, they're forecasting closer to 3% growth. And while that might be a few years away, it's still close enough from the point of view, are you going to invest $20 billion in a new oil field when China demand may be peaking? Your thoughts on the intersection point of that outside years, more significant decline in China growth, and where it will feature for that marginal oil demand?
I mean, let's not forget the 3% growth on the kind of economy that we're seeing in China today is still massive. And you compare it to 8% from a much smaller economy, that is still very sizable growth. In terms of oil demand, it's really interesting that oil demand is likely to peak. Product demand is, and certainly gasoline, is likely to peak in the next couple of years. I mean, diesel is an interesting one because we've heard CNPC or PetroChina say that it's already peaked in 2016, and yet we're seeing pretty solid diesel demand growth on freight, on industrial activity. But we've got chemicals and jet that will sustain oil demand certainly into the next decade. So there's still, I would say, at least a decade of demand growth from China. The other thing, if you look at a variety of forecasts, be they sort of IEA or corporate forecasts out to 2040, 2050, even as China's oil demand growth slows and then gradually starts to peak and decline, China remains the biggest oil consumer and importer in the world for another decade. Now, again, that growth sort of demand levels could go from the 14, 15 million barrels a day today to, again, your forecasts go from 10 million barrels a day to 5 million barrels a day in sort of the late 2040s. But even so, it's still the biggest demand center. And so for producers, that is still going to be the main sort of the main demand source in the market that they will be vying for.
Daniel, I took note this morning that Emirates NBD, your team has issued your daily note, but this morning's headline, U.S. consumer confidence rose to a 4-month high in May, was your lead. And obviously every day you put out a note, and that this obviously you decided was your lead today. So I'm curious as to why that was your lead, and what do you think it tells us about the direction of inflation in the US and hence interest rates? Your US consumer confidence as measured by the Conference Board rose to 102 in May, up from 97.5 in April.
I mean, in honesty, it's for lead because there hasn't been a great deal in terms of data coming out so far this week with holidays at the start of the week. But yeah, for US consumer, I mean, there's been some mixed data points recently, right? You had retail sales, which came in pretty weak in April. So perhaps the strength there is starting to ebb. This was a bit of a surprise to me. This latest reading of consumer confidence is improving. Presumably on the expectation that rates will start to come down, inflation will start to come down. Inflation is still 3.4% on the previous reading, core inflation higher. It's still not where the Fed wants it to be. And when you look at some of the other data points, you know, it's holding up. The labor market has slowed, much lower on the NFP last month, JOLTS slower as well. But generally, there hasn't been a kind of like drop off in activity. Nothing within that would suggest to us that the US economy is heading for a recession. We didn't think that last year. It didn't happen. It doesn't look likely this year either. So inflation, we think it will continue to track down, but not very rapidly. And for the Fed outlook on the back of that, we adjusted to 2 rate cuts this year, first coming in September, 50 basis points in total. But you look at the commentary, you look at Neil Kashkari yesterday, it's still leaning towards the hawkish side. So I think the risks to that outlook would be fewer rather than more. But you know, generally, I think the outlook is that it will continue ticking along. But there's nothing particularly to worry the US economy that is going to prompt the Fed to think, oh no, we need to cut sharply now.
Just final word with Ilya. Yeah, I also noted on your recent report with the Oxford Institute for Energy Studies, energy quantamentals. If there isn't enough things to try and contain our minds, quantamentals is a big word. But in your article, you make note that it sort of reversed the thinking a little bit, that the interest rate may not impact the oil price but the opposite. The oil price could impact interest rates. Your thoughts on that as a closing comment?
I think it ties back to actually comments by both of my colleagues, Mikhail and Daniel. I think the risk is ultimately on the downside here. I think inflation is a big risk, and the risk in high oil prices can contribute to it materially, along with other commodities. Look at copper, look at cocoa. If hedge funds starts allocating more money to other commodities, including oil. Oil is actually very, very cheap. That's going to be inflationary. So, and if you add other comments again by Michal, for example, escalation of tariffs with China or something else with China, or with comments by Daniel that the consumer sentiment is quite high. What if we are in inflationary period still? Inflation is still high, and that last mile on inflation is very, very difficult to bring down. So, I mean, the risk is that we're going to be at 5% for much, much longer. So that's, I agree with everybody. And the oil can contribute to that for its own reasons.
Well, we're going to have to wrap it up there. Oil, Brent crude oil trading at 84.39, and the survey result there indicating that despite the positive news from the IMF forecast on China growth, at least this room doesn't think it's going to have much material impact on OPEC's decision making, which will come as expected on Sunday, if not before. That is a wrap for us today. Thank you so much, Ilya Buchev, managing partner of Pentalon Investments and also the author of Virtual Barrels, Daniel Richards, MENA economist at Emirates NBD, and Mikhail Maidan, head of China Research Program at the Oxford Institute of Energy Studies. Thank you all very much for your time this morning, and have a great week. All the best.